JJ has an indicator on this chart. What is he teaching us now? It's probably going to be something dealing with retail because it's an indicator. Nope. Nope, nope, nope. Nothing dealing with retail or SMC, also known as smart money concepts. It's something that's been around for a long time. 50 plus years. Yeah, very, very long time. It's called the commitment to traders, as you've seen from the thumbnail and the title. What in the world is commitment to traders? In short, commitment to traders is basically the big boys report, the billions of dollars, those people, okay? Every week they have to report their trades, report how they take their trades. Well, I think it's every day. Every day they report their trades, and that data is compiled every week into a chart, which will be this down here. Now, there's different types of commitment to traders data. You got legacy, you got deaggregated, you got financial, you got there's a lot of different types of commitment to traders data, but you want to stick with legacy, which is what we're going to be looking at now. And then there's three spectrums of the legacy. You have small traders, which is dumb money. You got large traders, which is the larger dumb money, like millions of dollars dumb money, hundreds of thousands dumb money. And then you have the commercials. Those people, the smart money. Whoa, yeah, see word I use there? Yeah, smart money. That's what the commercials are. And guess what? This chart down here is the commercials. This is their activity right here. The commercials, they consist of private equity, central banks, hedge funds, anything of that category. That's what the commercials includes, okay? Now, the commercials, this data down here, okay, they will tend to hedge against price for future, I guess you can say, future order pricing, okay, for future prices to minimize risk and maximize profits. That's what they do. So if for example, this right here, right, this sell-off right here, they will be buying this, okay? They would be buying this. I know it seems crazy, but you know how sometimes ICT says in his videos, or even I say, price will come down to an order block and they'll be buying at that order block even though it's coming down? Same thing here. And matter of fact, this data actually syncs up with actual price action, meaning if they just start selling, suddenly start selling, there's an array or some sort of signature that calls them to sell. I can guarantee you. There's some sort of PD array right around here. It can be the disrespect of a PD array. It can be the respect of a PD array. It can be the immediate rebalance. Any of that, there's something syncs up with this point of selling right down here. See that? So got that high right there. That's created on the commercials data chart or the commitment to traders. And then look at that. You have that low that's pretty darn close to it. Yeah, see that? See that? Very suspicious, I should say. Very suspicious, right? And then as they start selling, like I said, they hedge against price for future prices. Since they have such insight on the market, they could do that. They can literally hedge against price and be like, okay, we're good. Price is going to go up later in the future. So we're like, okay, we can go and draw down $2 billion and we'll be perfectly fine. And that's exactly what happened. They started selling. This is them selling right here. They started selling this buy-side delivery. Okay, and then as price consolidated right here, if we come back down, you can see that price, not price, but they weren't really doing anything. They weren't selling nor buying. Overall, well, eventually after that, after them selling or, hedging against price but selling, they didn't really do anything. They were just buying, selling, buying, selling, buying, selling, buying, selling, and then they proceeded to start buying within this consolidation. Right here, this down move right here in the chart is when price started consolidating. After that, we started going back and forth, back and forth, back and forth, back and forth. They started buying this, okay? They started buying this. Now pay attention to what happens after they start buying. They're buying, they're buying, they're buying, they're buying, and it's matching up with this right here because, you know, the commitment to traders data is hiking, or the commercials data is hiking. They're buying, they're buying, they're buying, they're buying, okay? If they're buying, what do they expect to see in the future? They expect to see higher prices, right? So they are accumulating what? Buy positions, longs. They're accumulating longs within this consolidation. That's what's causing such accumulation, okay? Price proceeds to sell off. Uh-oh, we're down 10 billion. No, they buy more. They buy more, yes. I know it seems stupid, but yes, they buy more. With this sell-side delivery right here, they buy more. And guess what? Right when the buy-side delivery comes in after accumulating all those buy orders, what do? They start selling. They start exiting their longs. Whoa, crazy, isn't it? Yeah, it is just like the lower time frames. How price comes down, I don't know, the algorithms buy the order block. It's the same exact thing, okay? The algorithms, they run on the lower time frames. The central banks, they run on the higher time frames, daily and higher. Okay, I recommend you look at this data on the weekly. As you can clearly see, we're on the weekly. We're going to be looking at this chart just from here to here, all the way from May 2019 to now, which is, you know, July 28th, 2025. We're going to be looking at this data here and basically analyzing it. But I just gave you a little sample of what committed traders really is. We're going to do some syncing with actual price data, as in this right here. We're going to look at some actual buying within price of the commercials. Okay, let's start from here. Let's start from back here. We have this gigantic consolidation right here. Let me move my mic back just a little because I can barely see this right here. It's right in my face. So we have price consolidating. But look, what are the commercials doing at this time? At this consolidation right here, back and forth. What are the commercials doing? They're buying. Remember, these hedge funds, private equity, central banks, they know what price is going to do, no matter what. So when they're buying, they're not buying for no reason. Whatever they do, it is not random. Okay, understand that. It is not random. They are buying for a reason because they know, or they will tend to manipulate prices. Okay, that's what they do. They manipulate prices by hedging against price, and then once they sell their orders, boom, the market absolutely dumps. That's basically what's going on here. But they're buying, and then right here, see this? That right there is called a commercial extreme. The deepest point of buying before they begin to reverse their orders. That is in a commercial extreme. Vice versa, if they're selling, continuously selling, and then they proceed to buy, that low that's created on the chart after they stopped selling is called a commercial extreme. So after this commercial extreme was created, well, not even that. When was it created? Let's look here. Let's put a horizontal line. When was this commercial extreme created? Right there at that jump up. That displacement up. See that right there? That displacement up is when they started selling. Okay? They had a major, just crazy sell-off rate. You see that? This you can call this displacement in a sense. This right here is displacement syncing up with this. Okay? As soon as price kicks in, boom, they start selling off. But after that, price proceeds to consolidate. What do they do here? They sell more. Boom. Sell. Pretty cool, isn't it? But now watch this. We're going to put a horizontal line right here. Now we're going to zoom in. Just bear with me here. Bear with me. I promise you. Just bear with me. You see this fair value gap right here. Oh, yeah, I see it too. And then if we look down here, we see this little hike up right here. What does this mean? Whenever you have this and they're already selling, whenever you have this right here where the chart comes up and then comes back down, that high that was created on the data chart right here indicates selling. There's been more selling. Okay, there's been more hedging against price. But they sell where? Where do they sell at? At this fair value gap. Okay. They get out of their positions right there. Absolutely amazing, isn't it? I know. Very, very amazing. So we're going to go over this one more time. They were accumulating buys right here. Okay. They're accumulating buys right here. At this displacement here, once price starts, getting energetic, it consolidates for a little while. That's what this was. They weren't doing anything here. They were, in fact, actually buying a little bit and then sold off again. That's what this was. So they came into this order block right here. I mean, not order block, but this fair value gap. Price coming into this order block, they took attention to this and they said, okay, let's buy more and then sell it. That's exactly what happened. We're going to go over this one more time because you need to understand this. At that commercial extreme, price began to get energetic, very energetic. They saw this and were like, okay, we know where price is going now. Since it's getting energetic after all this accumulation of, long orders, we're going to proceed to sell. That's what happened. Boom, bunch of sell orders came in, okay? Price starts consolidating. They don't do anything around this time except for buy a little bit more. Then once price displaces higher, what happens? What happens after this displacement higher? They begin to sell. Fair value gap is created right there. Price hits the fair value gap. What happens? Let's put a horizontal line. They buy more at that fair value gap, and proceed to sell more. Why do they buy more? It's a fair value gap. Like what? It's a PD array. No duh. Okay. In a sense, the commercial, no, not even in a sense. The commercials are smart money. They are literally smart money. Okay. If this does not convince you enough to say that the commercials are smart money, then hey, that's on you. But the commercials are literally smart money. Understood? This right here is enough proof. Just the activity of how the commercial data is acting at these, I guess you could say, what's the word? Sequences of price. It's too convincing, especially for me. Once I found out how to navigate the commitment of traders, it really blew me away. But anyway, price hit this fair value gap, respected the equilibrium of it, body staying above it. Commercials, they proceed to buy more and then sell it. When do they sell it? When price starts heading higher. You see how the horizontal line is lining up with this point of selling right here? Now, what are they selling exactly? What exactly are they selling? Remember earlier, they accumulated all those longs in this consolidation. See this? They're still buying. The chart is still going higher. But what's going on with price action? It's accumulating. Oh, yeah, I know. It's accumulating, but what is being accumulated? Longs are being accumulated within this accumulation. Okay. Now, I have a model based off of this consolidation that's been already uploaded to this channel. But if you want to keep it simple, what they are doing is they are buying at every purge of sell side liquidity. We can study this, we can come back to this later, but if you just want to take a quick glance, you will notice that they buy at every purge of liquidity. Come down, purge, sell side. Come down, purge, sell side. Come down, purge, sell side. Come down, purge, sell side once again. And then again, come down, purge, sell side. And then again, come down, purge, sell side once again. So this is not random. Okay, understand that. This is not random. Looking back over here, they are selling, okay, following up that question, they are selling the accumulated longs that were over here. Very, very simple, right? How? Why? How do we say that they're accumulating longs? Well, pay attention, but to both. To both the actual commercials data and the chart itself. Buy side liquidity is being accumulated. What does that mean? Longs are being accumulated, okay? And sell side is being purged. Sell side is continuously being knocked out. And the commercials are buying at the sell side liquidity. So in short, I'm not going to make this, too explanatory. They are accumulating longs within this accumulation, and their accumulating of longs is literally syncing with price. And that's what's creating their hedging against price, or them selling, okay? Because they're selling all the long orders that accumulated here at this fair value gap. Very, very cool, isn't it? Yeah, I know. Well, we can see down here, if I draw a line right here, down here they proceeded to stop. They were like, nah, I'm done. I don't want to buy anymore. We can put a line here, right along there. Boom. Now, typically when they do this, okay, whenever they create a commercial extreme, it's not going to do it for no reason. Okay, it's not going to do it for no reason. It's going to hit some sort of PD rate. This can be anything. An inversion fair value gap, a fair value gap, an order block. It can be literally anything. Understood? Okay, you got it. There's multiple PD arrays here. You got this fair value gap all the way over here. Whoa, see how the bodies stay inside it? Very, very cool, isn't it? You got another fair value gap right here. You got an inversion right over here. For the ones that like inversions, I know some of you guys love inversions, but me personally, I don't like them because I just can't trust them. Me personally, that's all me. But you guys might like them. And then we have this rejection block all the way over here. Okay, boom, rejection block. So we have a rejection block, that being this right here, and then we have a fair value gap. Now let's pay attention to what happens at these times. The commercial extreme is created. Let's pull this over just a little bit. The commercial extreme is created. Boom. Let me turn this off real quick. It's created. After it's created, what does price proceed to do? Accumulate. It accumulates. What are the commercials doing? They are buying. They are buying that accumulation. They're actually buying that accumulation. And if you notice, sell side is being purged. They're buying the purge of sell side. And if you look again, they're buying this fair value gap right here. See that? They're buying this fair value gap. Price hits higher. They sell a little bit of their orders right here. See that? A little short-term sell right here. That's what they do. This little short-term sell. After that, they see price hit this fair value gap and its rejection block. The rejection block mainly being the hit, and the fair value gap is simply being accumulated in within, you know, all these candles, just a bunch of bodies within it. But the bodies do not leave it. If you pay attention, all the bodies stay within it. The wicks do a little bit of the damage, but that's okay. The main part is the candles actually staying in the range itself. Okay? And that the wicks doing the damage actually hit this rejection block, respecting its equilibrium. Because normally, if the equilibrium is disrespected, you would, you know, expect price to disrespect it. But again, once that commercial extreme was created, they proceeded to buy this fair value gap. They bought at this fair value gap. Boom. Okay? They headed higher. At that, you know, jump higher, they sold a little bit of their orders. Over here, commercials, the commercial data jumps once again. Boom. It jumps. But where? Where does it jump? If we look at price, it's selling off. Selling off from what? This fair value gap. Very, very cool, isn't it? Buying at this fair value gap here, as you can see here. Delivery higher. A little short-term sell-off, or little short-term exiting of positions right here. And then you got commercials buying once again. Boom. At what? This right here, this sell-off. Now, we have some, you know, little sells right here. We can zoom in and see exactly what they were selling at. So let's pull this in. Let's see. Let's pull. Let's put a horizontal line, not horizontal, but a vertical line right there. All right. Now we have a couple things here. Well, not even a couple, but some things here. If you look closely, we have this mitigation block. It's probably a little bit small, but I'll pull it back this way so you can see it easier. We got this mitigation. Let me delete this line. Oh, why does it do it like that? Come on, really? Whatever, I'll pull it this way. We got that mitigation block here, okay? That was hit, well, accumulated in right here. It accumulated within the mitigation block here. And then we actually have this order block here also. The mitigation block did get disrespected on this candle because the mitigation block's candle high was disrespected. So that wouldn't count anymore. And instead, we'll be using this order block right there. It hits the order block, but look what happens here. Look what happens down here. See that little slight push down? See that? See how the commercials data drops a little bit? What does that happen around? If we pull our cursor all the way up and directly up, it's on that candle. And what does that candle do? It accumulates within this order block. Didn't I tell you the commercials data syncs with price action? This is your proof right here. This is your proof right here, okay? This is literally your proof. Price heads higher one more time into that fair value gap. What do? They sell. Whoa. Very, very cool, isn't it? Now, after they do that, after that buy side delivery into the fair value gap, they see price respecting it. So what do? They buy. Commercial extreme is created right here, and they buy, and continuously buy. But if they're buying, shouldn't price be going up? Didn't I tell you earlier? They hedge against price. Okay, reason being, so they can get future prices, better future prices for their orders to minimize risk and maximize profits. The entire way down, what were they doing? They were buying until down here. The reversal came in, and boom, they started selling the buy side delivery reversal here. Very cool, isn't it? Yeah. I'm even shocked explaining this to you. Some people wouldn't offer this for free, but guess what? It is free. I'm not going to charge for something that's been out for over 50 years. I'm a 14-year-old. That's just, like, really, come on. Anyway, we're going to analyze every point of buying within this run here. Might as well squeeze it down just a little bit like that. Alrighty, this first, we're going to do this here. Why not? We're going to do that point of buying. As a matter of fact, no, that was the fair value gap, so that's excluded right off the bat. We do have a little dip here. I don't know what PD array it lined up with. Well, and also, like I said, it doesn't have to line up with just a PD array. It can be a signature. Signature in this case being a liquidity purge. Whoa. Whoa. Yeah, very cool. Came up, purge short-term high, drops. They buy at that liquidity purge. But there's something else that's being accumulated in. That mitigation. That mitigation right there. One of the strongest PD rates to exist. Let me see if that's actually a mitigation. That might not be. Nope. It is a mitigation. This candle is lower than that one. So yeah, that is a mitigation block. So price is accumulating within that mitigation block right there. But they bought at the liquidity purge. So with the side confluence of the mitigation block, Price came up, boom, purge buy side liquidity. They buy the buy side. They buy it, okay? Price heads lower, price comes up. Is there a point of buying here? Yep, look right here. See that? Yeah, look at that. Pretty cool, isn't it? You see that little short-term drop right there? It's very slight. I can highlight it if you want, but it's very slight. It's right there. I need to turn off that arrow just a second. No, it's right there. See that little very miniature drop right there. That's them buying. Okay, what do they buy at? Well, there's a couple things here. Fair value gap, and then guess what? Another mitigation block, but its Sally doesn't hit it. So one thing we have is the mitigation block, which is, well, not mitigation block, but the fair value gap, which is right here. As you can see, there's the buying at the fair value gap right here at that point. And then guess what? It proceeds to drop even more. So basically think of, in short, the commercials, just flip it, okay? If you were buying and if you expect price to go up and you're buying, the commercials are selling it. That's basically what it is. If you're buying, commercials are selling. It sounds crazy, but yeah, that's exactly what they do. And you could use their hedging to obviously depict future narratives and future prices. Obviously, right? And that's exactly how you can use this. Because their data isn't just data for no reason. It can be used to, like I said, depict narratives and to get accurate readings on future prices on the higher time frames, of course, just to have that passive narrative in the back of your head, like, okay, on the weekly we got the commercial selling at this point, okay, on the daily we got the commercial selling at this point. It's just a very passive narrative, not so direct, not so aggressive, but it's just there just to clarify. That's what this is kind of used for. That's what I use it for personally, because we're not going to be trading the weekly time frames and holding trades for months on end. So for our use, this is going to be a passive narrative type of concept. Okay, this is what this is going to be used for. And once again, price comes up into what? Uh-oh, here we go again, JJ. Yep, a fair value gap. Whoa, so cool. So cool, JJ. Hit another fair value gap. Oh my god. Yep, boom. Fair value gap. Look at the committed traders data. Whoa. Yeah, look at that. Right before it gaps down, they proceed to buy after the respect of that fair value gap. Whoa, super cool, isn't it? Yeah, I know. Very cool. So let's remove this line and then remove this line. After they buy, price proceeds to, drop. Okay, it proceeds to drop. They buy once again right down here. Do I need to zoom in on that? Right there. Let me grab my brush real quick. Grab my brush. Right there. That very small point of buying right there. But what do they buy at? If we look, we have a volume imbalance right here, respecting its equilibrium. Where's my volume imbalance thing? Okay, here we go. We got that volume imbalance with this mitigation block too. Wow, that's a nice set of PD arrays right there. Mitigation block with the volume imbalance. Price hits it right here. If we look down here, it syncs up. See that point of buying? If we put a horizontal line there. Whoa, very, very close, isn't it? Yeah, I know. Very, very close. As you can clearly see for the couple of analyzations, they don't exactly buy at the mitigation block, but they'll, not mitigation block, but any PD array or any signature, they'll tend to buy at the breakaway of that signature or PD array. Because if we look and we put it on the candle that hits the volume imbalance, they're not really buying. But if we put it on the candle afterwards, like after it starts breaking away from the volume imbalance and a mitigation block, that's where it really syncs up. Okay, that's where it really syncs up. But they will prepare to buy at the touch of the volume imbalance. They'll prepare, but they really, really buy once it expands away from it. They're like, okay, yep, it's going lower. Basically, they trade like us, in a sense. They look for that confirmation too. It's being shown here. They wait a week or two. Well, no, I'm not going to say that. It's not a specific amount. Do not take my word on that. But they'll prepare before they buy. Okay, that's exactly what happens here. 2 candles after this red candle here, they buy right there on that candle. Very simple, isn't it? Price comes up once again. Boom, hits what? Fair value gap. Whoa, amazing, isn't it? Now what happens here? Bodies stay within here. Wicks do a little bit of the damage, but guess what? That's fine. That's fine. Now if we put a horizontal line here, whoa, super close. And like I said, like I just said earlier, they will tend to officially buy at the breakaway of the PD array or the signature that we're analyzing. In this case, the fair value gap. And if we put it on the candle that breaks away, it lines up right with that commercial extreme. Yep. Yeah, I know. Very, very cool, isn't it? And then price proceeds to dump. I think they buy a little bit more around here. Yep. We put a horizontal line here. I keep saying horizontal. Vertical line, JJ. It's not horizontal. You sound retarded. Okay. Vertical line. My bad. Put a vertical line on that candle, hitting this fair value gap right there. I'm going to pull that up a little bit. We can. Hits that fair value gap. And proceeds to sell off again. And then right here, around this area, is when they proceed to sell all their accumulated longs from all these signatures and PD arrays that they bought at. Okay, so they were accumulating buys. Like I said, they hedge against price. So this entire run lower, they are accumulating buys. And once price starts reversing, or once they get the intel or the insight or the insider info that price is going to go higher, they're like, okay, let's start selling. Because look at this. They sell before price even reverses. Do you notice that? Look, hold on. Look at the line, right? The line is on the commercial extreme, okay? The vertical line is on the commercial extreme. Look at this. They start selling their orders literally before price reverses. Yeah, so this just shows you, okay, or what this should show you, and how you should be taking this in, is that these people know more than me, more than ICT. They know, okay? Even ICT has said that himself. They have insight on the markets that we can never get. It's called insider info, okay? Because they started selling right before their actual reversal. And if we put another line right here, when they started, not doing anything, that's when price started reversing. And then once it did that expansion higher, guess what happened? More selling, and more selling, and more selling, and more selling. And we're going to analyze the rest of this, okay? It's not too much. I won't make it too long. Promise you, I won't make it too long. And yeah, let's go ahead and dive right into this. All right, let's see this fair value gap here. It got tapped. They proceeded to buy at this fair value gap right here. Yeah, I know. This is like the fourth fair value gap. I'm sorry. This is literally the only PD array we have here. the only one. But fair value gap. Well, no, we do have this breaker. My bad. We have this breaker right here. But we're going to delete this fair value gap and delete this line. So we can highlight this breaker. I'm going to put it right about there so it won't make too much of a mess on our chart. Boom. There's that breaker block right there. Okay, we're going to delete that line. And if we look, this is the candle right here. Boom, that's the candle. If we drop down to the data, you can see we got a very miniature hike right there. See that hike? See that hike right there? That's them selling, okay? That hike right there, boom, sell. And then price proceeds to, keep going higher. That's what that is. That's what's going on. The proof is right here. Price comes down, boom. They come up in a very small, minuscule amount and sell a little bit more. And then boom, they sell more. they proceed to keep selling. After they sell right here, okay, they proceed to sell even more. They continue to selling. Why? Because price is still going higher. It's not stopping. Still going higher, drop down, go higher, drop down, go higher. Price is still going higher, and they know this. They're not stupid. They have insight that we could never get. All right, so they definitely know. It's hedge funds, private equity, central banks. They know. Okay, we're gonna look at this move lower and see what PD array or what they bought at. Basically, we're not gonna make it too complicated. So we're gonna put a horizontal. I said it again. Okay, I said it again. A vertical line at this drop lower here. Okay, there we go, JJ. Yeah, a vertical line. A vertical line. Okay, vertical. Say it with me. Vertical, 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 vertical. All right, we got it. Vertical, 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 vertical line. We're gonna put a vertical line at this low that was created within the buy side delivery here, and see what happens on the actual price action, and what happens with the commercial data. Commercial data, they proceed to sell more right there. They proceed to sell more, and boom, it drops lower. What happens here? After After they proceed to sell, what does price do? Hit higher after that. But what PDA rate does it hit? Does it hit any PDA rates? We do have this breaker. Actually, my bad. We do have this breaker. At this breaker, they proceeded to sell. Once again, price came down. They exited a little bit of positions here, and then they proceed to continue selling here at this breaker block. If I mark it here, at that breaker, we're going to remove this fair value gap and this breaker just to clear our chart. If you look here, that candle that creates the low within the buy side delivery here, hitting that breaker, creates a commercial extreme right here where they proceed to sell more as price goes higher. Okay, price comes down once again over here, hitting, let me delete this line, hitting this order block right there. See that? That's the order block right there. Hitting that order block, and as I told you before, they're not going to always buy at the touch of the order block. They're going to buy at the displacement away or the breakaway of the order block. And as we can see, if we pull this over at the commercial extreme, that's exactly what happens. They sell as price moves away from the order block. This is that candle right here. It moves away just a little bit, and then boom, there's that, I don't know, what's this? Yeah, 3,000 point candle right there. And then you're like, okay, sharp sell, boom. And that's that curve lower right here. Now this is where it gets interesting. Price proceeds to consolidate, okay? But if you get into this situation, you want to really pay attention to what the commercials are doing, okay? Let's look at that. After this rundown here, as I, mentioned earlier in the video, literally in the first 5 minutes, this is what, broke the trend, okay? By coming down, breaking these lows, as some retail traders will see it, but even still, as a smart money concept trader, you can still say this broke the trend, because after this sell side delivery lower, it broke the lows, and then after that, proceeded to consolidate. So you can say that the trend has stopped or price is consolidating. But within this, what are they doing? They are, they're buying. Actually, yeah, they're buying. What's the funny part? Yeah, I know. It's the actual funny part. And if you look, the commercial extreme of when they stop buying, is when they stop selling, is right there. Whoa, crazy, isn't it? Yeah, absolutely amazing. Literally, after the selling of that order block, okay, and the expansion away, they sell one last time, and then, hear me out, and then, okay, just hear me out. Volume imbalances can be hit multiple times. Whoa, yeah, I know, that was crazy. Volume imbalances can be hit multiple times, just no consequences, there's no catch, okay? Volume imbalances can be hit multiple times. Price comes up, hits the volume imbalance. After the expansion away off of this order block, causing the commercials to sell, when hitting this volume balance, they proceed to buy. They shift their I guess you can say, what would be the word for that? They shift their narrative. They shift their narrative and like, okay, we're gonna buy. Reason being, they know that price is gonna go higher in the future. Yeah, I know, it sounds crazy, isn't it? They're buying the lower moves. It makes no sense, doesn't it? But hey, that's them, and that's the way they make their money, and we're gonna use it to make some money. Okay? Price comes down, in a sense, breaks the trend or stops price from going higher, and then consolidates. I'm not going to get into the specifics of this right here, but if we look, what are they doing? They're buying within this consolidation. So if they're buying, what are they expecting? They're expecting future prices to be higher, right? On September 30th, 2024, price expands outside of the consolidation. What do? They buy even more. They're getting very aggressive with it now. Very aggressive. They buy even more. Around here, they stop. They start selling. Just a very slight amount. They're very small. See that very slight curve right there. What's going on here? Price is also consolidating. Consolidating at what? Whoa. Entry drill. See that? Whoa. Is that an IO fed? or some call the institutional order flow entry drill. Yeah, I know, it's right there. Amazing, isn't it? What is the entry drill? Price does not hit its equilibrium. See that? Never gets touched. Period. So an entry drill is being created as price is consolidating, as the commercials are not buying anymore. So what should that tell you? Their expected buy-side delivery from accumulating all these buys should be what? It should be happening. It should be delivered very, very soon. And shortly afterwards, price displaces fast. Very fast at that. In a large amount in a very short amount of time. 14,000 points. Let me move this out of the way. But starting from here. Oh, come on, really? You're messing up my video, man. Come on. All the way up here. About 15,000 points or 1,476 pips within, I don't know, what's that, 6 months? Well, no, not 6 months, but 190 days. Very, very fast and very large. Okay. That's how you use the committed traders data, or really the commercials data, not the committed traders, but the commercials data within the committed traders to get a passive narrative on the weekly. Okay, I recommend you use this data on the weekly because on the daily it looks a little weird, and I'll show that for you. Here's the daily. If it'll load. Is my computer just terrible? Okay, there we go. But yeah, it looks very weird, as you can clearly see. It doesn't look right. It's just very, I can't really explain it, but it's very stiff. It's very stiff. But the weekly, it's slow. I mean, not slow, but it flows much better, as you can clearly see. It flows much better on the weekly. So you can use the weekly time frame and use the committed trade, the commercials data to get a passive narrative on the higher time frames to know where price is going to go. Remember, they hedge against price. Okay, they hedge against price, and they will be hedging at certain signatures and PD arrays, and you can use that sentence right there. You can use that to help you assist on finding what the commercials are truly wanting to do. Okay, so whenever you see a commercial extreme being created, look around immediately. See what PD arrays are being hit or even being disrespected or respected, and what signatures are being created, such as immediate rebalances, liquidity purges, anything of that matter. Okay, anything of that matter. And to finally end this off, I'll be giving you guys this indicator in the description. I'm no gatekeeper, okay? It's going to be provided to you in the description so you can use it, and this tracks the commercial data. Remember that. This is commercial data, not small traders, not large traders, commercial data, so you can use it with your weekly time frame on whatever forex pair, whatever commodity, whatever you trade on, okay? I don't think this can be used with bonds and stuff like that. I'm not sure, but I will be giving this indicator to you in the description so you can use it. I won't be gatekeeping it, and that'll be it. Good luck and good trading.